Okay. We up now?
Yep, here we go.
Thank you for that. You know, I'm always appreciative for any of this technology assistance that I can get. Okay, now I don't know whether I'm going to be able to do this or not, but let's try. Bunmi, you may have to help me out with that. I do have. Okay, while you're recording, you can't do that, it says. Okay, interesting. Okay. I was trying to, that's probably why I should have prepared this earlier with you. But anyway, there's a couple of websites that really go into explaining the fact that there are benefits that are, and I'm sure everybody's heard about the fact that there are benefits that are available to self-employed and unemployed and gig workers today that may apply to some of the individuals on this call today. If for any reason you were affected by the shutdowns that have occurred, you can actually apply for unemployment benefits, and that's something really new that would not normally apply. So if those benefits are available and you are eligible for them, I'm certain that you want to take advantage of it. Also, the SBA has been injected with substantial funds now for small businesses, and I've got information on that as well. So in the event that you want more details on any of those two programs as far as unemployment is concerned, or as far as the small business loans are concerned, and you want some resources on that, you can reach out to me and I'll be happy to share that information with you. There are links that you can go to. They've done a great job of summarizing that. And I think you would all, you know, if in fact you know someone that has a need for that, this is a great opportunity to share that information. In the meantime, let's get right into the core meat of the matter here. I've got some outstanding speakers lined up, and I want to start out by, first of all, introducing a young lady who I met who has really impressed me of her skillfulness, her ability to network and reach out to the public in her real estate world. And she is a consummate real estate professional. Today, since this call is designed to really give some additional impacts for those that are in the real estate industry, because of the fact that they are being affected in a very unique way. You know, at a time when in this particular area, real estate was booming. You know, it was an opportunity to really prosper in that field. And now we're dealing with a whole different set of circumstances that are impacting on that. And so I know that she's going to touch on the fact that credit is an issue that is impacted on buyers and individuals' ability to get financing. So Marlene, if you're there, I don't know if you kind of...
I'm here.
You're here? Oh, okay, great. Okay, could you just give us a little insight? First of all, introduce yourself. Secondly, give us a little insight as to what your current experience is that you're encountering now in this new environment that we're in, this challenging environment, and how you're coping with that. So Maureen Wallace, can you introduce yourself to some and reintroduce yourself to others?
Oh, sure. Maureen Wallace. I've been in this area for over 20 some years, and got into real estate about 3 years ago, and wish I'd gotten into it long before now, because I completely enjoy helping folks with their real estate needs, whether it's to buy, to live, or to invest, or to sell. And like Vernon said, the market has been great, And during this time for spring, it's usually even better. There's more activities around this time, but of course, because of the corona, there's less activities. We're restrained to what we can do when we go out to show houses. The fortunate thing is we are considered essential, so we can go out and still conduct business, but we're conducting business differently. We, following the COVID rules, making sure you stay your distance, wearing your gloves, using hand sanitizers and so forth. So we're still doing that, but again, the market is slower. And as of last week, I think it was on the 30th, March 30th, the announcement came out where FHFA has changed their criteria on the credit. So before, as a 580 credit score, first-time home buyer or any repurchasers with that credit score was able to take advantage of an FHA backed loan. Now that has changed. So lenders are looking anywhere from 640, as a matter of fact, to even some are asking for 680 credit score. So where you would have a conventional loan requirement for credit score of 640, now you're competing there just the same with a FHA loan. So that has definitely changed the market. And so what we're doing, we're working with buyers who were had prior pre-approval at a lower credit score, and now we have to work with them with getting their credit to where it needs to, doing different things with their credit to get it where it needs to, so they could buy. So that is a challenge there, but we're working through that with various resources there. And that's the thing with any part of the market. You have to rethink how you're going to do business, think about the challenges and how you can overcome those challenges, and just be mindful of that, and just keep focused on what you're trying to accomplish, so that you can stay ahead of the game and stay ahead of the market.
Excellent. So what are you doing when you find a situation where you have a 580 credit score and then all of a sudden you need a much higher score? What happens to those clients?
So those clients, if they are willing, and usually they are, because especially if there's a time crunch or there's a time period that they're looking to meet, if it's to get a friend or a family to add them as a authorized user on a credit card or something like that. Of course, the credit card needs to be not carry a high balance, no more than 30%, and a long history, credit history.
Right. And
so that's one way we're doing if they don't have the time to wait, or they will just have to wait it out, and based on what's on their credit, having to address those. Sometimes we do work with credit repair specialists as well where needed, and if the time permits.
Okay. And so what are they saying there in your office as to the duration of this? When do they have a sense of how long this is going to last, or what?
I know. We all wish we had that ball that we could see, and no one knows. We are right now, I would say that the market is still healthy in the sense that we still have buyers and we still have people who are selling.
Okay.
So that's healthy in its sense, and also because people are not selling their homes for less or rushing to sell because there's not a need right now. It's not impacting, say, market value of homes. Later on down the line, depending on how long this carries out, then there may be some impacts to short sales and foreclosures. People not being able to recover financially, either being able to get their jobs back or, whatever, just get back on their feet. Because while you could get a forbearance that carries you out to maybe 90 days, after that 90 days, you're supposed to come up with that full amount.
Right.
Right. Some people may not be able to do so. And some, so who knows what that's going to be. We're projecting that there will be some change in the market and will become more of a buyer's market.
Right.
But when will that happen? We don't quite know.
And how does that affect the agent's cash flow?
If you don't have a strong pipeline, it could really affect you, because like I said, now is a time where you would find a lot more buyers, a lot more activities. If you're getting leads from various sources, Zillow or so forth, all of that is somewhat subsided. It's not as heavy of a traffic anymore. But if you had clients in your pipeline, those are the ones that, they still have that need to move. So you still need to work with them. So it can impact, realtors. And so it's important, I think as a realtor, to always have your pipeline of clients, always working to keep that pipeline fluid, because anything could happen.
And have you seen your closings be postponed or canceled as a result of this?
I have not yet. I've seen a slowdown in terms of my buyers wanting to rush or feel like there's a haste to to move ahead. But while in the process, I haven't had an experience where we had to delay a closing because of court or anything like that. Because now they're doing the online filing for the deed, the recordation.
Okay. Well, I want to thank you. I know you have been doing outstanding. I know you've won all kinds of awards. If I am correct, I think you were like Rookie of the Year or something. Give me a little. You've been so modest here on this call. Just give yourself a little bit of bragging rights here, real quick.
I did get Rookie of the Year, I guess it was. Closed the most deal in 1 month after being new into the business. And thereafter I wasn't even paying attention to the top 20. I got into the top 20, then I made it to top 10, and then I made it to top 5, and then made it to top 2. So and all within 3 years.
Wow. So you're a go-getter, right?
Yes.
So why should a potential client that's listening on this call want to call on you, Maureen?
Why should they call on me? Because I give them the attention. It doesn't matter what level of buyer they are. I give them the same attention. They were making a joke today, Maureen, do it for the love, not for the like. I don't know if you know that song. Do it for the love. Yeah. So, I do it for that. And so I treat all my clients the same, because today one client may be in this situation, tomorrow they may be in a different situation, or they may know somebody else who's in a different situation. So I look at all my clients equally, and so I treat them with the individual care that they need. Okay.
So if someone wanted to reach you, what would be the best way for them to reach you?
Text or a phone call, and my number is 240-779-5900.
You want to give it one more time?
240-779-5900.
All right. Well, thank you so much for sharing that information. I'm certain that everyone who's listening would benefit from your know-how and your customer service. So that is the combination that I see that's most evident in working with you. So thank you so much, Maureen, for coming on. Okay?
Thank you, Vernon. I hope this was valuable to someone.
Absolutely, absolutely. I want you to stick around. Might call on you for some parting words.
All right, I will.
Ms. The next person I would like to introduce onto this call is someone that I have known for many years. She is a leader in her field. She's a super achiever, someone who has the ability to make things happen. And that's the one and only Miss Bunmi Moore. Bunmi, are you there?
Hey, Vernon, I am here.
Okay, glad to see your face and glad to hear your voice.
Thank you.
Bunmi is an exceptional business person. She's very serious about what she does, but she has the ability to reach out and make everybody feel at home and at ease. She is someone who I believe is a major team player, and she is one in which we partnered with because of the fact that she represents a company that is making a major difference in people's lives today, particularly during this period of special challenges, such as the challenge that Maureen just spoke of when it comes to the real estate field and the challenges that are being faced with the lending side. So without any further delay or further ado, let's get Bunmi on and kind of explain to us exactly what you have with your presentation and the partnership that we have between TeamWorks and your organization.
Okay, awesome. Well, thank you, Vernon. First of all, I want to swing it back to you for just having the vision and the foresight to bring us together on this platform where we can share some positivity and talk about how we can still prosper in what most people say are uncertain economic times, how we can have clarity and make sure that our futures are still certainly very, very bright. And so I want to say good evening to all of you. I see some of my old friends on here. I see Vaughn Resper and I see Reggie Widgeons. Hello, guys, and some others of you out there. So I'm very glad that you all are here to hear this information. Now, before I start into this presentation, one of the things that Vernon actually asked me to speak to how we collaborate with real estate professionals and mortgage professionals and help them to sell more homes and close more loans even during this time. So I'm going to speak to that. And those of you who are here because you heard about an opportunity with MWR Financial, you definitely need to take a look at the full business presentation and the full membership presentation. So we'll give you information or get back with Vernon and he can tell you how later on this week or as soon as tomorrow you can see that full presentation, because tonight we're really speaking towards those real estate and mortgage professionals, but you'll get, your interest will be piqued with what we are sharing. All right, guys, so let's get to it, and I'm going to actually share my screen. And Vernon told me I've only got 10 minutes. So I'm just gonna do my best to give you guys a real overview in just 10 minutes time here. But Vernon and I have recently collaborated together. I'm really excited about this partnership. And as you listen, we want you to see if you can, if anything resonates with you and you can join in on our vision. And so recently Vernon has collaborated, formed a partnership with a company called MWR Financial. If you're taking notes, write down Make Wealth Real. And isn't that what we all want to do, right? We truly want to make wealth real, not just when the economy is doing good, even when there's a crash, even when things are bad, we want to make wealth real. Even in the Depression, people got rich. So we're here to inspire you, to tell you, it doesn't matter about the coronavirus, you can prosper and win at this money game. And so we have one of the most comprehensive financial memberships out there for consumers. And what this does, if you're a real estate professional or a mortgage professional, what this membership does is it provides your clients help with almost any financial challenge that they have. And so the main challenge that your clients right now need to get over so that you can sell more homes and close more loans would be the credit challenge. But again, I want you to understand this is a financial solutions membership, and everything in the membership helps to put your client on a better financial footing. And what makes it really appealing is the price. You see that $79.97? Everything that we're going to talk about is wrapped up in a small membership that's just $79, the cost of like less than what a dinner costs, and that you might not even like the dinner. But here we have $79 giving you experts, putting your people on sound financial footing, and that even includes their spouse. So it's a lot of value. Now let's talk credit, because the more credit worthy your clients are, the more homes you can sell, the more loans you can close. What if there were a way for your client to increase their credit score 150 points, between 50 and 150 points in an average of 2 to 8 months? That's absolutely possible. That's what we do through Credit Max, which is just one of the 4 pillars of this membership. Now, Credit Max has over 25 years experience. They have a spotless record with the Better Business Bureau, over 100,000 satisfied clients. So it's not somebody who says they know how to fix people's credit in the back closet somewhere. I mean, this is a reputable company, almost 3 decades old. So you can feel very, very comfortable with referring your clients to this membership and this credit piece. So again, the more a person's credit score goes up, their interest rates come down. As Maureen was saying, now the qualifications for home buying, for loans going through, have now become more stringent just in the last 2 weeks or so. And so more people than ever need this credit restoration service. So all of the things that you see there are included. So people are excited about this credit piece. We even have a credit rebuilding piece as well. So write that down, write down Credit Max. And remember, it's not that it costs a husband $79 and a wife $79. $79 includes 2 people. Then there is a part of the membership called Equity Max. Let's talk about debt to income ratios. That's very important when it comes to qualifying for a home. What if there were a way for your client to be totally debt-free in 1/2 to 1/3 of the time without spending any new money? So this amazing system helps people to literally turn their debts into wealth. And one thing that happens as you share this membership with your clients, not only are you helping them to purchase a home, but you're literally helping them and showing them how to now pay it off early without spending any new money. And so your clients love you and they refer you to other people because you didn't just put them in the home. You showed them how to pay it off. You got their credit score higher. You help them to save thousands of dollars in interest, not thousands, hundreds of thousands of dollars in interest. This example that I'm showing right here, I won't go through the whole thing, but basically understand there's a creditor's plan for your money, and then there's the Equity Max plan for your money. This shows how you can save nearly 22 years from being in debt because of this system, saving you hundreds of thousands of dollars in interest. Now, our debts are one of the biggest hindrances to our wealth building. And we're going to have Mr. Garth Vickers. He's going to talk about this wealth accumulation piece. But the sooner we can get out of debt, the sooner we've paid off Credit One and Capital One and Wells Fargo, the sooner we can now take that money and shift it to where it belongs, back into our household. And that's all we're doing here, guys. It's about income shifting. Because right now, someone else has your money. I want you to understand that. Uncle Sam has your money. The credit in the bank system has your money. Inflation takes away your money, and big business takes your money. So all of those things shift our money away from us. So if you want to win at the money game, anybody besides me want to win and win big? If you want to win at the money game, you've got to figure out how to shift that money back into your household and then take that money and get into the I quadrant that Garth is going to talk about and get your money making money for you. So this membership does all of that. And it even gives your clients unlimited financial advice on demand without paying $250 an hour to a CPA or CFP. Yes, they have access to CPAs and CFPs and enrolled agents with the IRS, but guess what? They don't have to pay $250 an hour. It's included in that $79 unlimited financial advice. Any type of question that they have, how to structure their business, how to get an instant pay raise on their job without asking their boss, how to get additional tax write-offs, all of that, unlimited financial advice on demand. Cash flow strategies, remember, is not in what we earn, it's in what we keep. And so in order for us to become a millionaire, we gotta align ourselves with people who have millionaire thinking and people who have already achieved what it is that we want to achieve. So this small $79 membership lines us up with winning the money game by putting experts in our corner with this done-for-you solution, meaning they're not going to teach you how to do your credit. They're going to do it for you. They're going to give you the plan for getting out of debt. They're going to make sure that you have financial experts so you don't have to figure out this thing by yourself. So as I end, as an entrepreneur, when this was brought to me by Terrence Hawkins, some of you all know him. He's a majorly successful CPA out of Charlotte. But he knows the power of residual income in this home-based business industry. When he brought this to me, I was like, okay, I'm already a six-figure earner. I'm making really great income. But still, every piece of this membership I needed. I needed to increase my credit score. I had gotten into debts I needed to get out of in record time. I needed the financial advice and help with my taxes. And I was behind on my wealth building. And I'm like, oh my gosh, you're going to get me straight for $79? And I know a lot of other people too who are like me in the home-based business industry or who are even 9-to-5 employees, W-2 wage earners, and they need an instant pay raise. They need to know how to shift their income. So guys, I got fired up and really excited about that. And so, Vernon, this is the last thing I want to say, because for all of you all watching here tonight, take some time to really find out what MWR Financial is about. Being in the home-based business industry, I've never seen a program that pays 80% back to the field and literally with just 3 people, you referring 3 people to the business who would be a business partner with you. 300 million people in this country who want to improve their finances potentially. All you need is 3. And we get 12 on your team from that 3. Now you got a guaranteed income of $20 a day. That's $600 a month. Now, when Garth shows you how to parlay that money into an investment, into a vehicle where you get great upside potentials when the market is going up, but when the market is going down, you can never, ever lose money. And when it comes time to take out that money, maybe you want to, for your retirement, you can get it tax-free. See, this is one of the secrets that the banks and the wealthy have hidden from us. And now we're here to lay all of this on the table. So how the wealthy align their selves, you can do the same. So it's all about you and your clients becoming, like, aligning themselves like a financial expert without having to be one. So Vernon, I know we're limited time. I just wanted to pique people's interest. I'm really fired up about this. We have so many testimonies. So get back with Vernon and he'll share with you the full presentation so you can find out how you can make wealth really real in your life. Thanks, Vernon.
Thank you so much, Bunmi. Before you leave, I want to make sure I recap here. So if I'm a real estate agent or a real estate professional or mortgage banker, mortgage lender, loan officer, you mean to tell me that you've got a program where if I had credit challenged clients that I can refer that client to you and MWR, and they have experts that are going to work on getting those people's credit maximized in the shortest period of time. And all of that for only $79. And that's $79 a month. And that's for 2 people. So that could be a husband, a wife, a couple of some type, a child and a parent, a grandparent and a child, whatever, and that lives in that household. Is that correct?
An incredible value. You're absolutely right. And let me say this as well. So that 79 is for a customer, somebody who's not in the business. They're just getting that membership. Mm-hmm. And then that can be free for them, because even customers get a referral link. Everybody whose credit score increases, they know other people who need credit restoration as well, or anything else that we have is all included in that membership. They refer 3, now their $79 goes away, and now they get all the benefits of the membership without paying, as long as they have referred 3 or more. Isn't that phenomenal?
3 and it's free.
Yep, get 3.
Wow, that's great.
And then let me tell you one other thing. So Maureen spoke about, and I know a lot of other my friends in real estate, they're like, okay, well, in between the time I sell a house and sell another house, like I need more income. So they love the residual income. So look at the business side of this. You can get into the business for just $228 if you're looking for more business income and that residual income. And so now as you refer your clients to the membership, that's bonus income, bonus money coming into you from customers, and residual income from the customer's membership too. So agents really like that.
That's outstanding. Now, also, let me make sure I understand. Now, you also said something about an instant pay raise. So basically what you're saying is that the financial experts can look at that financial situation of that client, and they can come possibly with ways that within that current income structure that they can adjust the W-4 and find ways that they can take home more money on a paycheck by paycheck basis. And that's what you call your instant pay raise, because they can also take advantage of the business opportunity, right? Mm-hmm. And have those write-offs associated with a business ownership. Is that correct?
That's correct. And the average instant pay raise is between $300 to $600 a month. And you know, the average family would not have to file bankruptcy. They just had an extra $300 to $500. So with that instant pay raise, so many more people are just like, they're loosening up the financial belt. They're putting that money into the private reserve account that Garth is going to talk about. They're not struggling anymore. You know, they're using it to get out of debt. So that instant pay raise is pretty powerful, but you got to work with the experts. It's not just about changing your W-4s. You will get yourself into trouble. But these experts know exactly what it should be. So you're not giving Uncle Sam an interest-free loan on your money all year long. Wealthy people would never do that. You got to make sure we employ the habits of the wealthy. Get your money now. Our experts will show you how.
And the last point is, you're saying to me that if I had a client and they were buying a home and they had a 30-year mortgage, with these experts, through your Equity Max program, you could find ways to put them on a program where they could pay that off in 15 or maybe 10 or even 8 or 7 years, that 30-year mortgage, without paying any more on a monthly basis? Is that what you're telling me?
Spending the exact same money. The system will show them the special way how to get it paid off in 1/2 to 1/3 of the time. I'm telling you, buy back your life.
Amazing. All that for $79.
All of that for $79 tax deductible dollars for most people.
Okay. So look, if there's anybody on this call that's interested, you would recommend that they give me a call, that they reach out to me so that I could show them the additional information that they can get with the details, how they can get all of the information completely transparent so they will know the value that we're talking about today. Thank you so much, Bunmi, for making this clear. All right?
You're welcome.
Okay, next I want to introduce someone who I have been so totally impressed with from the very first day I met him. His name is Garth Vickers. He is not only my financial mentor, but he is an expert in the areas of accounting. He's an enrolled agent for the IRS with his tax preparation knowledge and skills and tax planning skills. He has the estate planning skills. He has been an amazing asset for our financial team. So I had to partner up with Garth Vickers and Vickers Financial Group. Garth, are you on? Come in, wherever you are.
Oh yeah, I'm here, Vernon.
Okay, you unmuted yourself.
All right, let me
Thank
see.
you so much. It's good to hear your voice. It's good to see you now. You're there on the screen.
Let me see. I need to see myself. Hold on. Oh yeah, there. All
yes,
right, cool.
You're here. You're here.
Man.
So I want you to take the floor because you've got some amazing information to share. And our audience today was dying to hear from you. So without any further ado, Mr. Garth Vickers.
I mean, thank you very much, Vernon, and thank you very much, Bunmi and Maureen, and thank everyone who are on the line. I mean, it's definitely a pleasure, just being here to present to you guys, and I'm glad that you guys are out there being safe and staying home, practice your social distancing and everything, I wanted to start off this evening by just talking about some of the main updates dealing with retirement plans. And I can see there's a question in the chat box about retirement plans. Just so you guys know that the IRS now would allow you to take up to $100,000 from your 401k plan. No penalty, even if you're younger than 59 and a half, and you don't have to pay tax on that money for up to 3 years. What does that mean for you? It means that you can now take money, especially if you're in real estate, you can now take money from a pre-tax Vickers, and you can now invest that money into things that make money, and then you have up to 3 years to pay it back. Or you may not even have to pay it back, because what would normally happen if you didn't take the money? You'd have to pay tax on it later, perhaps at a higher tax bracket, right? So now you can use the money in your 401k to invest money outside of that tax trap that they set up for you guys. And you can convert it into tax-free income during retirement. And those are some of the things that we can help to set up for you guys. So I just wanted to, let me go ahead and share my screen here. And I just wanted to share that with you guys real quick. So let me go into the private reserve account that we're talking about today. All right, so private reserve account for real estate investors, how does this thing work? So the first thing we want to talk about today is the money rule. In everything in life, whenever you're doing anything, you have to know the rule. So the money rule universally is called the rule of 72. And the way this system works is the rule of 72 is used by the Census Bureau to determine the growth of the population. Banks and financial institutions use it to determine how long it takes for money to double. It's very simple. All you have to do, just take any interest rate given, divide it into 72, and that's how long it will take for your money to double. So it means that at a 4%, your money will double every 18 years. At a 6%, your money will double every 12 years. At a 8%, it will double every 9 years. At a 12%, it will double every 6 years. So you take this 29-year-old person who make a one-time investment of $10,000. At age 65, they would have $40,000. And if you go over here and look at the 6%, the 12% return on investment, when the money doubles every 6 years, right? When they 35, 41, 47, 53, 59, 65, the bank would have made $440,000 and this person $10,000. Then they would turn around and give you $40,000 for yourself and said, hey, can I lend you some money on a credit card, on a mortgage, on a car note, whatever, at whatever interest rate it is that they want to decide, depends on your credit. So that's how the system works when it comes to money. Here are some other mistakes that most people make. When it comes to real estate investment, this is what most people do. Now, typically, when a person becomes a real estate investor, it's either they're going to have an LLC that they normally flow their income to Schedule C, or they would have a 1040 and they would just attach a Schedule E. That's the normal way that most people do real estate investing, right? Now, let's say, for example, you have an income of $200,000 in real estate. What CPAs and tax annual agents and tax preparers normally do is for them to get you not to pay taxes on this 200,000. What they try to do is to find expenses against your income so that you don't have to pay the taxes. Now, look what happened. Let's say they find $180,000 worth of expenses. Now you only pay tax on $20,000. That's good because technically, depends on your tax bracket, you may just pay 22 or 24% on this $20,000. Now, how do you grow your business though? Whenever you're ready to apply for a loan and you go to the bank is going to ask you for your tax return, and they will see on your tax return that your income is $20,000. In your eye, you've seen $200,000, but your net income that is added to your AGI, which is a line item that lenders use to determine how much you can qualify for, is actually $20,000. So what's the solution? What if there was another way that you could show this $200,000 as your net income to the bank and you don't have to pay taxes on it while you're doing it? What if there was another way that you could do that as a real estate broker, as a real estate agent, as a lender? What if you can show someone that, hey, do you know that there's another way that you can do your tax returns so that you can show this entire $200,000 in your LLC and you don't have to pay taxes on it? Wouldn't that be amazing? You guys could use the chat if you want to use the chat. And let me ask you guys a question. Wouldn't that be amazing for you if you could show $200,000 as net income that you didn't have to pay taxes on, and you could do that legally? Wouldn't that be amazing, Vernon?
Absolutely. Absolutely. And you wouldn't, and you did say legally, right?
Legally.
All right.
So remember that there is a thin line between tax avoidance and tax evasion. You know, and how you can easily identify these lines is this. So tax evasion is like Wesley Snipes. Tax avoidance is like Donald Trump's. Both individuals did the exact same thing, but one of them end up in jail and the other one ends up in the White House. That's the difference between tax evasion and tax avoidance, is that one of them understand the IRS code that they pay experts to teach them how to move the money around legally. And the other person just decided, I'm not going to pay any taxes, you know? So that's sometimes the very thin line between tax evasion and tax avoidance. So let's talk about these things. And the power of real estate. Now, real estate I'm not saying that all of your money should be in real estate. I'm not saying that. But I'm going to say this. If you have a portfolio and real estate is not a part of it, I can tell you that it's not a complete portfolio. Real estate just have to be a part of your investment portfolio. And I'm going to show you why. Because real estate is the only asset class that has a line item in the expense category that can in return give you income. And I'm going to show you how that works. Let me see here. I just want to make sure that we get in all of these questions just so we don't miss anyone. If there's anything that we need to adjust. All right, good. So yeah, that's the only asset class that has an expense line that is actually an income. And this is the line item, depreciation. So I'm going to show you guys how depreciation is powerful, right? Now, let me show you this. Let's say you have an individual that has 5 properties. And I'm going to go very slow tonight just so you guys get it. Let's say this individual owned 5 rental properties. And let's say I'm just going to do the straight line depreciation. And they did a straight line depreciation on those properties, let's say for $20,000 per year on each property. Now, 5 properties, that's $100,000 in depreciation, right? Expense. I'm sure you guys follow. Now, depreciation expense is a deduction. Accountant know it as this. And tax returns, you have something that is called expense, and then you have something that is called deduction. Expense is what you actually pay, but there are other items that are called deduction that you don't necessarily have to pay, but you can use it on the expense line for reducing your tax liability. Those are called deductions. So depreciation is a deduction on the tax return, though it is not a necessary expense that you pay. So if you have accumulated depreciation that you use in this year of $100,000, right? At a 24% tax bracket, you just saved $24,000 in taxes. Now, what is compounding interest? Compounding interest is when you earn interest on your principal and interest on your interest. But what is triple compounding interest? Triple compounding interest is when you earn interest on your principal, interest on your interest, and interest on the money that you would have paid in taxes, right? So if you were to take this $24,000 and let's say you invest that $24,000 at an 8% interest rate compounding, which the S&P 500 for the past 34 years have paid an average 8%. And let's say you didn't have to pay tax on that money while it was growing. For 27.5 years, which is the normal years that a residential property can be depreciated, right? 27.5 years, that will be $2.5 million if you were to do that. Only real estate alone as an investment asset could do that for you. Only real estate. So if you were to do that, and if you use a combination of real estate and the private reserve account that we're going to explain in a few. So if you were to take this $24,000 that you saved from your real estate property, invest it into your private reserve account, which is making an average 8%, for 27.5 years, it will give you $2.5 million tax-free that you could use, tax-free, right? Now, we talked about the triple component interest, earn interest on your principal, earn interest on your interest, and earn interest on the money that you've normally paid in taxes, right? That's what depreciation in real estate can do for you. So here is the dynamics. There is something that is called ownership, and then there is something that is called control. I'm not sure if you guys are familiar with who the Rockefellers are, or the Rothschilds, or the Carnegies, and the JP Morgans, and the Mellon, and all these people of this world. One thing that all of these guys have in common, they own nothing. They control everything. And that's exactly what Nelson Rockefeller said. He said the secret to wealth is to own nothing, control everything. So if you look at a person who filed a 1040 tax return, that is the person who would normally pay taxes on this $200,000. I mean, have to pay taxes on this $200,000 if they didn't have expenses, right? No, the depreciation expense here at $100,000, you would only have to pay tax on $100,000 because it's depreciation expense. You don't pay tax on that, right? And here's a good thing about real estate. Even though depreciation is an expense for tax purposes, when you apply for a loan, though you only pay tax on $100,000, when you apply for a loan, you would use your entire $200,000 as income because the lender have to add back depreciation to qualify you for loan. That's also the process. That's how the system set up. But if you, that's just the ownership side of it. What if you were in the control side of it, right? Now, what if this entire $100,000 here was not going to you directly? This was going to a trust, which files Form 1041. Now, this $100,000 is going to a trust. As you can see here, you make $200,000. Your expense, let's say we're just going to use depreciation as the only expense for now. Let's say your only expense was depreciation of $100,000, right? Your net income that would normally go into whoever owns it, because if it's an LLC, you don't pay tax on the LLC, you go pay tax to the owner. So this $100,000 is now going to the trust. Now let's say, for example, the trust take $90,000 because a trust can do what an individual can't do. A trust can transfer 100% of its income or its asset on any given day to either its beneficiary or the charity of choice. Now let's say this trust took $90,000 of its $100,000 and donated to a charity. And I'm going to show you what charity you can donate it to. Now there's a net income of $1,000. At a 10% tax bracket, you pay $1,000 in taxes. That's fine. You pay some taxes. People can't say you're not paying any taxes. That's okay. But that's if you wanted to do that. You could donate the entire $100,000. But we're just using $90,000 as an example. Now that $90,000 goes into a private foundation, which the trust is setting up. Now you also the trustee for this private foundation. Now this foundation take this entire $90,000 and it go invest into a private reserve account. Now the private reserve account is something that you can borrow money from, but even when you use the money, you get to earn interest on it. So let's say you did a loan from the private foundation to an LLC owned by the trust for $60,000. Now, this $60,000, you put it inside of your LLC. I know you use a profit and loss projection based on that LLC to get a loan from a lender that would give you the money for real estate. Normally, these kinds of loans are normally a 6-month or a 12-month interest-only loan that you get to refi, and then you do a regular loan like FHA, conventional, whatever you want to do from there. So this could be your down payment for the property, but you get to refi it in 6 months. You take the money back and put it back into your private foundation. But here's a good thing. Even if you didn't pay it back, the company that manages this private reserve account for you will still have to pay your interest on this entire $90,000 as if it never take a dime. So it means that you get the tax break on this money when it comes in, and this entire $100,000 when it comes in. Now you get to donate it to your own private foundation. You earn interest on it. You get to use it to invest in real estate, and you get to put it back into your own bank, which is what your private reserve account is. And all of that is 100% tax free. So let's go into that a little bit more. Let's show you how the money works inside of this private reserve account when it compares to other investments. So most people put money inside of the market because they said, hey, the market pays an average 8% for the past 34 years. But is that if you were actually in the market, or is that if you were mirroring the market? Let's look at the difference. Now, let's say you were in the market, let's say a mutual fund, and you put $100,000 in and the market pays 8%. Now you have $108,000. And I'm sure everybody is following that, right? 8% on 100,000, 108,000. Now let's say the market went down the following year and it went down by 8%. Look what just happened. The average rate of return is 0, but now you have $99,360 because your money is actually in the market. Now, what if you were just mirroring the market to determine your interest rate, which is where indexing comes in? Look what would happen. When the market make 8%, you get 8% on your 100,000. When the market goes down negative, your money stays at 108,000. The following year, the market goes up 5%. This guy is at 104,000. Now you're at 113,000. Look at the difference. That's a 14.12% difference. So this market here would have to do another 14% for this guy in the mutual fund or the stock to catch you back. So with a combination of your private reserve account and real estate, you can create your own bank with 0 risk. Guarantee that you will never lose your money no matter what the market does. That's a powerful thing. Now, when it comes to money, there are 4 things that you must take into consideration: growth, safety, tax advantage, and the protection. Now, here is the thing. The biggest problem that most people make is that they started in this order. They focus on the growth first, then the safety, probably the tax advantage and the protection. But the way you really want to do this, you want to focus on the safety, the growth, then how you're going to pay tax on it, and then what happened when you die. That's how you want to look at it. You want to follow this way, right? Not this way, right? So let's look at all of the accounts that you can invest in and see how all of them work when it comes to these 4 concerns. So these are your financial vehicles. You have stocks and mutual fund, qualified plans, Roth IRAs, annuities, different types of annuities, and then life insurance. These are different types of investment vehicles that you can use. So let's see how all of these work when it comes to all of these things. Now, stocks, of course, there is growth. And we know there is not going to be any safety because it's an investment. The tax advantage, you pay tax on the money every interest you earn, and depends on your tax bracket. If you're at 37% tax bracket, you pay 20% on your taxes, and if you're at a lower than 37%, you pay 15% on the gain. And then the protection, the money may not be there when you die because it's a stock, or it's a mutual fund. Then these accounts here, they are sections of the Internal Revenue Code that determine how your money is going to be taxed, but typically they are stocks and mutual funds. So the growth is there, the safety is not there. The tax advantage, before 59.5, you have to pay a 10% penalty, and then you have to pay income tax after 72 distribution and all of those things. So it's not a way for retirement. They were designed to reduce your annual taxable income. Today, people talk about them as retirement, but they're not even retirement's cousin. The protection, the money may not be there for you when you're ready to die. Roth IRA does have some growth, safety, depends on how it is structured, maybe in the market. Tax advantage, yes. If you wait till you're 59 and a half and the plan is more than 5 years old, you get all of your money, your contribution, and your gains tax-free. There is no 72 rule. You don't have to take in a required minimum distribution. But in terms of death benefit protection, it's not guaranteed it's going to be there, and it may go through probate, depends on how it is structured. Annuity, fixed annuities, the growth is not there. It's kind of like a CD, so there's a fixed interest rate, so there's not much growth. There is safety, however, and the stocks last in, first out. If anybody have any question regarding last in, first out, you can just text me and we can answer that for you individually. But last in, first out is the way IRS determine that it's going to be taxed. It's either going to be first in, first out or last in, first out. So you have to pay tax on every dollar you use as long as there is gain. That's what that means. And then the protection, yes, there's always going to be a death benefit because there is no risk. Variable annuity, there is growth because it's in the market. The safety, no, there is none. Tax advantage, it tax the same way that fixed annuity is taxed, and the death benefit, it may be there because it may be in the market and it can lose it. Index annuity, there is growth. You get to mirror the market to determine your interest rate. That's all it is. Your money is not invested in the market. It goes up with the market, it goes negative, zero becomes your hero. And then the safety, it's always going to be there, and the tax advantage is the same way as it's taxed, and the death benefit is going to be there. Term insurance, there is no growth, it's just death benefit, and it's just death benefit, right? Whole life is like fixed annuities, but for life insurance, so there is not much growth. It's a fixed interest rate, pays and dividends sometimes, which is a return of unused premium. It's not the same thing as dividend in a stock. Let's get that clear. Then you have safety. It's always going to be protected. Tax advantage. Yes, you don't have to pay tax on the gain. It's tax exempt, tax deferred under Section 72E of the Internal Revenue Code. You get to use it tax-free under Section 7702 of the Internal Revenue Code. And the death benefit is tax-free under Section 101A of the Internal Revenue Code. So just like whole life, you have fixed universal life, and it operates the same way like a whole life. But this time, it means adjustable premium, flexible life. That means it's more flexible than a whole life, but it gives you a fixed interest rate, and it's treated the same way for tax and debt benefit purposes. Then you have VUL, which is a variable universal life. The money is in a mutual fund, so it's in the market, and then there is no safety there. The tax advantage, you do get it just like the whole life, and the debt benefit. It may be there, yes or no, depends on what the market does. Then you have what is called an index universal life, which operates similar to an index annuity, but has more tax advantage, and it has the growth way more than you will get in a fixed annuity, like you will get in a mutual fund, but without the tax, and it gives you the safety, and there is no taxes on the gain, and the death benefit is going to be there because you will never lose the money. So that is what we typically call our private reserve account. If structured properly, it can become your own bank. So if you look on all of these accounts here, in general, let's put a number with them just so you understand how the money flow in each of these entities. And this is my last slide, and I'm going to open for questions from you guys. So let's say, for example, you invest $100,000 across the board using all of these examples, mutual fund, 401k, real estate, Roth IRA, and a maximum funded life insurance. It needs to be maximum funded for it to work the way we're talking about it, for it to be your private reserve account. It cannot be any type of life insurance. It needs to be structured a certain way, and it needs to be maximum funded, and it needs to be allocated properly in the right indexing strategies for it to work as a private reserve account. So let's proceed. So let's say we have $100,000 here, and the fee to manage this mutual fund was 4%, which is $4,000. Let's say the market pays a 10% return, you made $10,000. Now your tax on that is going to be between 15 and 20%, which technically is $4,500 between tax and fees, right? So your net gain is going to be 4.5%. Oh, the market pays 10%. That's what they would say in a mutual fund. How much money did you actually make? You only made 4.5%. Because of a tax and fees, that's what you made. Let's look at a 401k. In this case, it operates the same way, except that you wouldn't pay the taxes on the money while it's growing, but you have to pay the tax on the money when you use it later. After 59 and a half, you can pay the taxes, right? In real estate, this 4% fee would represent your property tax. That's what that represents. And it's taxed the same way like a mutual fund because it's a gain, it's gain. And then Roth IRA, you invest the same 100,000, the 4% fee, made the 10% return, $10,000. You pay the 4% fee. There's no tax on the gain. Like I said, if the plan is more than 5 years old and you're older than 59 and a half, you will get the money tax free. Now, if you look on all of these fees, it's going to the investment group, the government investment group. Now, if over here, when you look at life insurance, now in life insurance, you put $100,000 in, the 4% fee comes off the top immediately. So you won't make 10% on $100,000 because there has to be a death benefit according to the IRS code for you to get this tax advantage. So this 4% is what you use to buy the death benefit. So that leaves $96,000 that earns its 10% interest based on what the market does, which will make you $9,600, right? There is zero taxes. And when you minus that 4%, which is buying the death benefit, now look at the return versus all these other guys. Your actual return is 9.6% in a 10% market when all these other guys are making 4.5 and 6%. You see that? So if you look at this and then look where the fee is going, the fee is going to buying you this death benefit so that when you die, your family is going to get this, or your estate is going to get this, or your trust, or your foundation, or whoever is going to get this. So in other words, every single dollar you put in your private reserve account is there to benefit you in the future. And that's the reason why banks are doing it. So if you look at, let me just look at one of these guys here. So this is FDIC website. So I'm just gonna show you guys Bank of America balance sheet. And in total asset, it says they have 1.8 billion, but dollar figure are in thousand. So it's actually $1.8 trillion. Now, that's their total asset. The total liability is $1.6 trillion, which leaves them $212 billion that they get to use that money to invest wherever they want now, because that's their asset, right? And it's going to show you everywhere they invest that $212 billion. Now, if you look at stocks over here, which is where most people invest, they got $3 billion in stocks, right? That's common stocks though. In preferred stocks, they have absolutely nothing, zero. Because they're not going to invest in a company that they don't determine. They don't have voting rights, right? Now, if you look at life insurance asset, this is life insurance asset here, $22.5 billion. Bank of America have in life insurance asset. And you may say, oh, that's the death benefit. No, the death benefit of life insurance is not called an asset. What is called an asset is this, the private reserve account. That's what's called an asset. The amount of bank holding of life insurance assets included are the cash surrender value of life insurance reported by the carrier, less any applicable surrender charge. And it shows you how they do it. The bank form a permanent life insurance policy owned by the bank and its subsidiary, and is set it up inside a grantor trust. And the policy is normally taken out because there has to be an insured, and its directors, its officers, its employee, and that's how they do that under an endowment, right? For collateral assignment, which is what they normally use to pay these people their pension when they're ready to retire. Guys, you can do the same exact thing that the bank is doing in your own company, because you are the employee, you are the officer, you are the director, which indeed gives you insurable interest. You can do that in your LLC, you can do that in your trust, and you can also do that in your private foundation, which creates an endowment. Is there any question for me?
Wow, that was amazing. That was amazing. So how come most of us have never heard of this before?
Because 2% of the people in the world control 98% of the wealth. And the 98% oftentimes think a certain way. You know, life insurance is not gourmet. You know, like all the other stuff, if you look at this chart here, Vernon, like all these other things are gourmet sounding stuff. Like when you hear about mutual fund and stocks, you know, like 401k and IRA. If someone asks you, where do you have money? And you said, oh, I have money in a life insurance. It don't sound as sophisticated as it sounds as I have some stocks, I have some mutual fund.
So you're saying it's not glamorous?
Right, it's not glamorous as those things sound. But as you can see, Bank of America don't care because they have $3 billion in stocks and $22 billion in life insurance cash value.
They don't care about the leverage.
Yeah, they don't care what it's on.
Yeah.
They just care how it works.
So you mean to tell me that when you start talking about life insurance, is this term insurance?
No. So as you can see, this one is a properly structured index universal life policy.
And what's the difference between the two?
So, good question. Let me show you that real quick. So I'm just going to highlight right here just so you can get the concept, because this is the best way that anyone can get the concept of how it works. So normally in a term insurance, the insurance company will name an amount of money that you pay. Let's say for 30 years, the insurance company said they're gonna charge you, let's say $300 per year, right?
Mhm.
And the benefit could be, let's say $500,000, right? Now, if you die in 30 years, the insurance company is gonna pay your family $500,000. Now, if you don't die in 30 years, you'd have paid all these $300 to the insurance company and your family would get nothing. So on the other hand, if you were to get a permanent policy like an IUL, right, the insurance company would say, pay me $1,000 per year, right? Let's say $1,000 per year. Now, technically, they can only use $300 to buy the death benefit. So the difference of $700 is what goes towards the cash value and it earns interest.
Mhm.
Now, most 99.9% of life insurance agents, this is where their education stops. Now, the secret to this is with this guy, the IRS. So inside of the IRS, there is a code, section 7702, that the IRS says, hey, you can actually put more money in this plan that the insurance company is saying you should put. Now, let's say the IRS determined, Vernon, that the amount you can put is $10,000 per year. The insurance company, by law, can only take $300 to buy the death benefit. Now, look what just happened. Instead of $700, now $9,700 goes towards the cash value. Now, if the market was paying, let's say 10% that year, the insurance company, by law, instead of giving you 10% of 700, they now owe you 10% and 9,700. By you doing this, it becomes your own private bank.
Wow.
Look at this. If you build your cash value up to $100,000, Vernon, and you wanted to go take up, let's say you wanted to go invest in real estate, right? And you took a loan for $60,000 out from your policy. And this money is now invested in real estate, making money for you, right? But guess what? If the market pays a 10% return that year when you took that loan out, now how much money you think the insurance company owe you for the year?
They would pay you the interest on the 100,000.
Right. Even though you're making money on the 60,000, you're still making money on this 100,000.
Right.
So now you're making money on 160,000, but you only have 100,000.
So what you're telling me is, even though you borrowed 60,000, the insurance company is still required to pay you interest on the 100,000.
And the 100,000 because you own this. It's your own private account.
Wow.
The insurance company don't own it. It's just one of the things that that comes in laws of ownership.
Okay.
You know, once you own the money, they have to pay your interest on it.
Wow.
Even when you use it as a collateral to take this 60,000 out, but they still have to pay your interest on this.
So if I took that $60,000 and bought me a property and flipped it, okay,
Yeah.
and I made $90,000 on that 60, that $30,000 profit, I could put that back into the reserve account?
Yeah. So you put that back into the reserve account and it just give you access to more money now.
So now instead of 60, I could put 90,000 back in there. So now I got $190,000.
That's correct. That's correct, Vernon, because it's your own bank.
What's the interest that was being earned on the 100,000?
Well, you determine the interest you pay back to yourself because it's your own bank. But the interest that is earned is determined by the S&P 500, the NASDAQ, the Dow Jones. Depends on the index that the insurance company is using.
Right. So that 100,000, let's say if it earned 10%, so that's 110 plus the 90,000. So now I've really just doubled my money, right?
That's why it's called cheaper compounding interest.
Wow. Wow.
because you earn interest on your principal, interest on your interest, and interest on the money that you'd have saved in taxes. And look at this now. Every day you have a new principal.
Right.
This account, every interest you earn becomes your principal,
That grows.
right? And it becomes your basis as well. That's an accounting term. Meaning, normally when you have a stock, right?
Mm-hmm.
And the stock appreciate in value. When you
Right.
sell that stock, you have to pay tax on the gain,
Capital
right?
gain. Right.
And the capital gain, and also on the dividend that you receive each year.
Mm-hmm.
With this insurance, remember you're not paying tax on the dividend that you earn in the gain. You're not paying tax on it, and it becomes your basis, your new basis. So whenever, if you wanted to go withdraw the entire amount, there is no tax on it either, because it becomes your new basis.
No, so you don't have to pay taxes on that then?
Zero taxes. And if you die, and this 100,000 now becomes $1 million, and your death benefit was $500,000, like we explained earlier.
Mm-hmm.
Now your family would receive $1.5 million tax-free
Oh my gracious.
because of section of the Internal Revenue Code 101A. This entire $1.5 million was not paid out under section 101A of the Internal Revenue Code, which prohibit the IRS from taxing proceed from life insurance paid to a beneficiary if the
So
policy is owned properly.
so this is what the wealthy people do to pass on from one generation to the next generation their wealth.
Right, and if you don't believe me, just go back and read the Rothschild story.
Mm.
And you'll see that the two main part of the Rothschild estate, where Rothschild is today, is trust and life insurance. And then they add the foundation later on, which they have now that do most of the work for them. But the trust in the Rothschild's estates state clearly that no disbursement of asset should happen on the death of any member of the family. However, each member of the family are qualified for loan, no matter what their credit is, they qualify for loan from the estate with these conditions. The estate have to own a life insurance policy in you.
Mm. I got you. Okay.
Yeah. That means no matter how much money you take, you may pay it back, but if you don't pay it back, you're going to die one day, right?
Right.
Yeah.
So they can't lose.
There is no way for the family to get poorer. Every person die, the family get richer.
Wow. Unbelievable. Now let me ask you this. Does this come under the category of using life insurance while you're living as opposed to just while you're dying?
Right. Because not only do you get to use the cash value, there's also living benefits in it, like chronic illness, critical illness, and terminal illness, and no extra cost. And then this is not technically, this is not really what people used to call life insurance. The old type is what debt is really a debt insurance.
Mm-hmm.
This is real life insurance because you get to use it while you're alive. Because as human beings, we always want to see what's in this for me. When I set it up, how does it benefit me? And this is where we put like the with him in life insurance. The what's in it for me.
So what's in it for me is that if you come down with a critical illness or a chronic illness, that you are able to access money now while you're living?
Yeah, I mean, I could run an illustration for you real quick. Let me just show you something here real quick, just so we don't just be hypothetically speaking this stuff, right?
Mm-hmm.
So let me just run some numbers here real quick. And I'm going to show you something here real quick that I did for this person here earlier today. So we've taken their monthly expenses, which is what we put in a private reserve account, and we put it into a bill pay account. They divide it by 3, put it into a bill pay account, and they use a credit card to pay their bills. They use a bill pay account to pay their credit card, and they transfer $52,000 into their bill pay account, which is a life insurance policy. So I just actually did the whole presentation for someone today and set that up, right?
Mm-hmm.
So I'm just gonna show you here, if we were to just do that alone, let's say we did Maryland, and this person here was 48 years old. Let me see if we got the right age in here. Oh, they were 45. Okay. So, so I'm gonna put this $52,000 in here just so you can see how this thing work, and then so in here we put $52,000 in, right? The
Right.
difference, $44,000, you can access that in 30 days.
Okay, this
No,
is in your private reserve account.
right. So now you can access this to go invest in real estate,
Mm-hmm.
right?
Right.
So look at this now. In addition to that, this, you have these living benefits. So if you have a heart attack, a stroke, a kidney failure, cancer, organ transplant, anything like that,
Mm-hmm.
like now we have all this coronavirus going on, insurance company paying a ton of money, right?
Right.
Now they will pay you $338,000 if it's minor, if it's life-threatening, $1 million. If you have a chronic illness, you're unable to perform any 2 of your 6 activities of daily living: bathing, toileting, transferring, continence, ingesting, and feeding. Depends on when it happens, $16,000 or $30,000 per month. Or terminal ill, doctor say you're gonna die in the next 24 months, $1.5 million. The death benefit is $1.3 million. And we're using the same amount of money that you would normally pay in your bills for $52,000 a year. Now, let's say we convert this into a retirement plan, Vernon.
Okay.
Let's say we did that. We said, okay, we're gonna do that. That same dynamics there. Let me go back to here. So the benefit here. Why is it not moving? Oops. Is the internet working? Okay, yeah. Yeah, you see, don't want to work for you guys, Vernon.
Mm-hmm.
Okay, so we may have to just rerun it. Let me just rerun it real quick. We got the same date of birth in there. Oh, so yes, this thing is not working. I was gonna show you how we converted into retirement.
Is it stuck?
Yeah, I don't know what's going to this software. Let me see here.
Maybe you got too many windows open.
Yeah, it could be. But let's see. Technology, man.
Mm-hmm.
But yeah, we don't have any choice now. It's coronavirus time. We just have to.
Yeah. See, there's a virus going around, right?
Yeah. All right, so let's just use that same information there. All right, so let's say we did that same exact illustration there.
Mm-hmm.
And now we're gonna put in that same $52,000. And remember, you can use this money while it's actually creating a retirement plan for you.
Okay.
So let's say we pay this to age 65, you know.
Okay.
So this person is gonna receive an income from age 66, and they were 45. So how many years is that? That's 17 years. Let's say put 17 years, yeah. So let's look at this now. And let's say their tax bracket is 34%. Let's leave it at 34%. Let's run this and see what it look like from a retirement standpoint.
Right.
So your private reserve account at $52,000 per year, which is the same money that you're using to pay your bills, you're just funding it this way, is gonna accumulate $1.6 million at age 65, which will pay you a guaranteed income for the rest of your life, tax-free, $149,585, tax-free.
A year?
A year for the rest of your life.
All right.
Now, if you were at a 34% tax bracket, let's say in a 401k plan, you would have to make $226,644
to equal that 149.
to equal this 149.
Because after taxes, you would be actually netting 149.
149.
If you had if that was your 401k.
Right. But let's say you live, right? Let's say you live to age 120 and you die. Your family will receive $9 million tax-free.
Wow. So, but if you didn't live to be 120, and let's say you live to be 90,
it'll be less than that, but it'll be
a bunch of money.
Yeah. So, and then you have these benefits.
All along.
And the initial benefit is $2 million.
Wow. And in the meantime, while you're building that cash value, if you need to borrow, you could borrow against it, right?
Right. 30 days after we set it up, 30 days, you can access the money right back and still earn interest on it. And then they have all of these billing riders. That's what this is what the rider is, a lifetime income benefit rider. That's a pension instead of life insurance.
That's guaranteed.
Yeah. Lifetime income benefit rider. Guaranteed.
So I'm hearing that because it's an index program, you guarantee not to lose any money, right?
Right.
Because it mirrors the stock market. Your money is not really in the stock market.
Right.
Because there may be a ceiling, but there's also a floor.
Right, and we can set it up where there is no ceiling either.
Right, but there's still a floor, so you can.
Yep.
So the worst that can happen is instead of it earning 10, 15, 20, 30%, if the market dropped and it lost, the market went down 20%, instead of you losing 20%, it would just stay at zero and you would have not lost one penny.
Right.
That's amazing. That is absolutely amazing. So why wouldn't everybody want to do this?
I mean, if everybody knew about it, they would be doing it.
Okay.
Yeah.
That's
So
that's our job.
yes.
Our job is to get this message out. And Teamwork's mission is to help 10,000 people utilize these services so that they can create, grow, protect, and pass on wealth, real wealth. And I think that if we all had the ability to put our money in a private reserve account. Now, this private reserve account, is that money going to Vernon, or is that money going to Garth? Where's that money going? Where's that money sitting?
Well, so we have different carriers. So National Life Group is one of the carriers that that we use. So the money is going to National Life Group.
And who are they?
So National Life Group, they have been around since 18. They're the carriers. They're the insurance carrier, and we don't call these kind of transaction investments because they are not investment, they're insurance. And one of the reasons why we don't call them investment is because when E.F. Hunter went to court with the IRS in the 1980s, E.F. Hunter had to prove to the IRS that this is not an investment in order for him to get the tax benefit that we now have, right? And they proved that to the IRS, and that's why we can still do it today. So it's not an investment, it's insurance, but it's insurance. The money is backed by legal reserved insurance carriers, which legally have to show the insurance commissioner each year that they have enough liquid asset that can cover all of the liabilities that they're about to take on. Let me explain to you what we mean by that. In 2008, over 300 banks went bankruptcy. Not one single life insurance company went bankrupt in 2008. One company was about to go bankrupt in 2008, and they were purchased by other insurance companies.
So nobody lost any money.
There is impossible for you to lose money. When I say impossible, I mean it's virtually impossible for you to lose money when you put it inside of an insurance cash value, only because of the way insurance is structured with the reinsurance and the guarantee board of association and all those things, which you can explain one-on-one what those things actually mean. That it is state-backed investment. It is reinsurance-backed investment. And reinsurance meaning that someone else can put up the money to back this insurance company. the liquid cash. Like for example, Geico is backed, the reinsurance is owned by Warren Buffett,
Right.
right? So these are billionaires that is backing the insurance controls 75% of the world's wealth.
What?
75%. As you can see, Bank of America have 10% of their money inside of it.
Wow. Wow.
Have 10% of their asset,
right. Assets. Right.
right, inside of reinsurance.
So you're telling me that insurance companies have more money than banks have?
By far, because remember that even though Bank of America may have that much money in asset, remember that they also have a large credit line, which is what they use to give you a loan.
Right.
But insurance companies, in order for you to be an insurance, like banks have 10 times the amount of asset they have in cash flow.
Right.
Because they can get 9 times the credit line from the Federal Reserve, right?
Right.
Insurance carriers have to have the money liquid in order for them to be able to insure me and you. So it means that how many of us is on this phone? 14 of us, right? If 14 of us were to get $100,000 coverage from National Life Group, and we all in Maryland, National Life Group would have to show Maryland Board of Association Insurance Commissioner that they have this $1.4 million in asset in order for them to insure all 14 hours for $100,000.
Wow. Wow.
That's the debt benefit. Just imagine the cash value.
Wow. Okay. So the money is safe. The money is in reputable institutions that have been around for 100 or more years.
So National Life Group has been around since 1848. It's the second oldest mutual company in the United States of America.
1848.
And normally we don't talk about carriers like that because we have over 300 carriers that we represent. But
Right.
because we just use them tonight, I'll just show you the length and breadth of our support system.
Right.
You know, we only work with AM Best rated companies that have proven track record that have to be over 100 years old and have been doing it for over 100 years.
So Garth, let me draw this picture in summary, in closing. Okay. What I heard was Maureen is an agent that is in the real estate business. She currently is representing clients who are in the market for buying properties, buying homes, okay? And because FHA now is tightening up on its underwriting, they're looking at credit because of the risks they see associated. There may be an uptick in defaults, so therefore they're pricing it in such a way now that they're going to ensure that they don't sustain losses that they can't handle. So they're tightening up on the credit criteria. Credit score is going up, okay? Bunmi came on, talked about MWR, which we partnered with, and MWR is basically in the business of providing the platform to improve people's credit, eliminate their debt, help with their tax planning, and put them in a position where they can find the resources to capitalize a private reserve account, okay? So on the front end, we're finding the way and the means to be able to fund your private reserve account, okay? Then I partnered up, Teamworks has partnered up with Garth, and Garth is now showing you how you can take that 500, 600, 300, $1,000 a month that's being freed up and now put it into a retirement plan, put it into your private bank, put it into an instrument that is safe, but at the same time has the upside potential of what the stock market has. It sounds to me like it's a seamless process here where all of this is working together to help create wealth for our clients and for their families and for future generations. I think it's a very comprehensive approach to this. And I want to thank you, Garth, for sharing this information, for enlightening us, for showing us how we can now join the ranks of the Rockefellers, the Rothschilds, and the others. So I want to thank you so much for that. So with that being said, are there any closing words that you'd like to say, Garth, before we say goodnight? And I want to have a few closing words before we do that. So
Okay, I just wanted to see if there's any question.
any questions? Okay.
Yeah.
If you have any, is there any questions that you want to raise right now with Garth? If you have, you can put it in the chat box, or let's see.
Unmute yourself, yeah.
Let's see, we can unmute yourself. You have any questions, you can unmute yourself.
So yeah, if there is no question, yeah, I just wanted, oh, I think there's one coming in, someone coming. Yeah, if there is no other question, yeah, I just wanted to add to what you just said, Vernon, that the private reserve account is not just for people who want to buy real estate. It could be a person who have some equity in their house, and they right now we don't know what the real estate market is going to do. The equity in the house is wasted capital. There is no rate of return on equity, and it's subject to market volatility. Mm-hmm. Why have it sit there? You could actually take it out after Bunmi work on your credit, and your credit is good. You can go take it out at a better interest rate. You may not even have to pay more mortgage, because we reset the mortgage to another 30 years. I can show you how you can pay it off between 7 to 15 years, the same way, without doubling your payment. Then you take that money, you go put it into your private reserve account. Then you can use it as a collateral to now go buy other real estate property that can create more cash flow for you.
That's amazing. That is amazing. Okay, if you have any questions that you think of afterwards and you want to reach out to me, please feel free to do that. If you want any more details regarding the private reserve account, please reach out to me. If you want to get more details on what Garth has to offer and the services of what Garth has, please reach out to me. I'll be more than happy to get that information to you, get you the point of contact so you can begin to build your plan for the future. Bunmi, is there anything that you'd like to say in closing?
Just want to thank everyone for just being attentive and just caring enough about their finances to be on here and truly do something different. But remember, guys, it's not about the knowing and just getting the knowledge. It's about the application of the knowledge that we get. So let's be action takers and definitely give Vernon a call. Thank you, Vernon.
Thank you. Maureen, are you still there if you want to say any parting words?
I'm still here, and I just wanted to say thank you, Vernon, for organizing this. And, you know, I think it was valuable, and I hope that others find it valuable as well.
Thank you. Thank you so much. I want to thank my guest speakers for coming on and sharing their knowledge, tremendous information. Thank you, Bunmi. Thank you, Maureen. Thank you, Garth. Phenomenal presentations that you guys made. I want to thank the attendees for hanging in there. I know we've gone way over time, but so much great information. I didn't want to cut it off. We're going to be back next Monday at the same time. Be on the lookout for notification of that. We may go into other subjects. We may have other speakers to come on, but we're certainly here for the purpose of sharing this information so we can all rise to the top. I want to pray that you all be safe, that you respect social distance and all of the other requirements necessary to keep yourself safe. And then let's all join together next week. I'm going to make sure that everybody is unmuted and we can all say good night. And that's going to be too many people to unmute. I'm just going to say thank you, everybody, for coming on. I appreciate it all. It's been great. Look forward to us all meeting again very shortly, and hopefully in the near future we'll have this virus behind us and we can all meet in person. Thank you so much. And at this point, the recording is ending.